Good. Good evening, class. Good evening, class. Thank you. So where did we stop in our last class? 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 Thank you, Mary. So where did we stop in our last class? Where did we basically stop in our last class? Where did we stop in our last class? So remuneration packages, we stopped at what I call remuneration. We stopped at remuneration. Remuneration, call it packages. Remuneration packages. So we did discuss, we classified them into two. So for tax purpose, we basically had two, what we call the cash benefit. One, and the second was what we call the non-cash benefit. What we call the non-cash benefits. So we had the cash benefit, and then we had what we call the non-cash benefit. Did we start on the cash benefit? I hope we started on the cash benefit. So where we say that for the cash benefit, we can have it as a recap. This is benefit that accrue to an employee in monetary terms. Benefit that accrue, we call it that accrue to an employee, to what we call to an employee, we say in monetary terms. So benefit that basically accrues to an employee, basically in monetary terms. And we had the first one. The first one, we basically called it main employment. We had it as the main employment income. So on the main employment income, we basically say that for the main employment income, it basically includes salary bonuses, salary, we add the bonuses, we add the leave pay, we had the leave pay overtime, etc. So for what we call the main employment income, we had salaries, we had bonuses, we had the leave pay, we had overtime, etc. Are we together? etc. Are we together? etc. together. What did you say about main employment income? What did you particularly say on the main employment income? As I had some ink to my pens. What did you basically say about the main employment income? The all taxable benefit except for people with disability. Taxable benefit, we said taxable, call it benefit. And you say except for people with what we call with disability, where for people with disability where, and those having the exemption certificate where the first 150,000 per month, what happened is exempted from tax, is basically exempted, where the first shillings 150,000 per month is basically exempted from tax, where the first shillings 150,000 is basically exempted from tax. Are we together? Then you have what you call the next, what you call the cash allowances. What you call the cash allowances. So for the cash allowances, we had house allowance, traveling allowance, hardship allowance, house allowance, allowances. We had the traveling allowances, cash allowances, house allowances, traveling allowance, medical allowances, medical allowances, medical allowances, car allowances, car allowances, comma, we add what's called the per diem, etc. So for the cash allowances, what did you say about cash allowances? What did you say about the cash allowances? What did you say about the cash allowances? So what did you say about the cash allowances? And I remember made a statement. If somebody was to make a statement that all cash allowances are taxable, is that statement true? We definitely say that that statement is not true. Let's get that. That statement is not true, especially for the part of per diem. So per diem, what did you say? The first, we said, allowed to statement, the first 2,000 per day is exempted. We call it from tax. This is up to when the first 2,000 per day is exempted from tax. That is up to, we say up to the first, up to June 30th June, up to 30th June 2025. However, we say that from 1st July 2025, this is up to how much? For 1st July 2025, how much is per day exempted from tax? That should be 10K. That should be 10K altogether. I want us to look at the finance bill. That's basically on the finance bill. So these are emerging issues. These ones you can be asked. Are we together? Losses in taxation, based on the new finance bill. Losses in taxation can be carried up to, businesses' loss can be carried up to how many years, based on the changes in the finance bill? Is it still up to 10 years, up to 5 years? Based on the changes that are in the finance bill, losses can be carried up to maximum of 5 years for which together. But that is done on the cash allowances. So we have the third, where you say employer. We have employer paying fees. Employer basically paying fees. We say employer paying fees on behalf of employee, on behalf of employees, on behalf of employees, we say to the employees dependent, to the employees dependents, to the employees dependents, on behalf of the employee to the employees dependent. So basically under this, we said we had two things happening. We have a scenario where it's taxable. We have a scenario where it's taxable. And then we have a scenario where it's not taxable. So the first scenario where it's taxable, where is it taxable? The first scenario where it's taxable. The way it's taxable. The first scenario where it's taxable. The first scenario where it's taxable, we say if the school fee is included in the income statement, if the school fee, we say is included in what's called in the income statement. If the school fee basically is included in the income statement, you will tax altogether. So if the school fee is included in the income statement or treated as allowable expense, In that case, you're going to tax the employee. To get a team, in that case, you are going to tax the employees together. You give me a yes if you're together. Victoria, perfect. So then the second scenario, we say where it's not taxable, if the school fee was not included, so what we call disallowed in what we call in the income statement. If the school fee was not included, so disallowed in the income statement, then therefore it is not taxed on the employee altogether. It is not taxed to employee. Then it's not taxed to an employee. If it was not included, you don't tax the employee together. So that is on the school fee. That it should be done. So then we go to what's called medical benefit. We go to what we call medical benefit. We go to medical benefit. So basically, when you talk about medical benefit, this is basically where employer, we say that where the employer is basically paying what we call medical expenses of employees or dependents altogether, paying for medical expenses of employees or dependents. Under this scenario, we also have two concepts on this. We have a scenario where we taxable, scenario where it's taxable, and we have scenario where it's exempt. So which scenario do we tax? Which scenario do we tax? So if it's, we tax where? If the scheme, we say the scheme is what we call is discriminative. If you have a scheme that is discriminative, meaning paid to a fee, paid to what we call to a few employees. So if you have a scheme that is discriminative, meaning basically being paid to a few employees, we tax. If we have a scheme that we say is discriminative, basically implying that a scheme where the medical bill is paid to a few employees, we tax altogether. For example, you can be told the medical bill was only paid to what you call to the senior managers altogether. That is discriminative. The second scenario, we understand that it is exempt, paid to all. Paid to all. The word is all, not only senior, paid to all employees. Paid to all employees. And the word is, this is basically what's called the non-discriminative. We call it the non-discriminative. So this is what's called the non-discriminative. That in scenarios where that is non-discriminative. Together, we respond to the yes if you're together. Then we get to the next concept, that is insurance. We call it the insurance. Call it the insurance benefit. Insurance benefit. Number one, if you're paying for yourself insurance, is it a benefit? Is it an employment benefit if you're paying for yourself insurance? Is it an employment benefit? If, for example, that is not an employment benefit, perfect. So this is now scenario where employer, we understand that where employer pays for employee, where employer meets insurance expenses for employee, where employer meet what we call insurance expenses for what we call for employees, where the employer basically meets insurance expense for what we call for the employee, where the employer basically meets insurance expense for the employee. Are we together? So where the employer basically meets insurance expense for employee. So in that scenario, it takes the life cover or education cover. We can say for employee independent, we understand that that is a taxable benefit. That should be a taxable benefit. We say scenario where employer basically takes what we call, we can have a life cover or education cover for the employees and dependent, then that is what we call a taxable benefit. However, if you take a cover for yourself, then that is not a benefit. That is not an employment benefit. Then you have employers' contribution, employers, what you call employers contribution to what you call to employees, to what you call to a pension, scheme. Pension schemes to what you call provident fund. So employers' contribution on behalf of employee to a pension scheme or what you call a provident fund. Or a provident fund. So when you talk about pension schemes, the two types of a pension scheme are we taking up? There's basically what's called two types of what we call a pension scheme are we taking up? So we have a pension scheme, what we call a registered pension scheme, registered pension scheme, and what we call unregistered, call it pension scheme. So basically, if an employer is paying on behalf of employee to a registered pension scheme, how do you treat it? If employer not taxed is basically exempt, meaning you don't tax. However, if employer is contributing on behalf of employee to what we call a registered scheme, example, we have an SSF is a registered scheme. However, if employer is paying on behalf of employee to what we call unregistered pension scheme, we will say what? This is in this scenario, this is taxable. This is basically taxable. Together, this is basically taxable. We respond with a yes if you're together. We respond with a yes. Perfect, Katerina. Then we have what we call the cost of passage, the cost of what we call of passage, the cost of passage. So whenever we talk about cost of passage, whenever we touch on what we call the cost of passage, we understand that the cost of passage is basically the cost of movement altogether from one place to another, because of employment paid for by the employer. The cost of moving from one place to another because of employment, and this is basically paid by the employer. On this, we basically say that there are basically three scenarios. There are basically three scenarios where this we say is exempted, where this is basically exempted, we call it from tax. So you basically have three scenarios where the cost of passage, which I've said, the cost of passage is the cost of moving from one place to another in the course of employment, and this is basically paid by the employer. So I've said that in relation to passage, we basically have three scenarios. We basically have what we call three scenarios where we do not tax it. Number one, if an employee is a non-citizen, implying that employee is an expatriate, are we together? Implying that the employee is an expatriate, you don't tax it. The number two, if the whole amount, if basically the whole amount in question was basically for passage, are we together? The number three, if the employee is basically in the country for the sole purpose of serving the employer. In those three scenarios, we don't tax passage together. In those three scenarios, we don't tax passage together. So say one employee employee is what we call a non-citizen. Number two, we'll say the whole amount, we say was basically spent on what we call passage. The whole amount is basically spent on passage. The employee is in the country. We say for the sole purpose of serving what we call serving the employer. Meaning is not engaging in any other business, but basically is in the country for the sole purpose of serving the employer. Is basically in the country for the sole purpose of serving the employer. So apart from this, it is going to be taxed. Exceptions of the above, we say tax. So if these things are not there, then if any condition is violated, you tax. So if any condition is basically violated, you basically tax. If the conditions are basically violated, you tax. Then you go to employer's contribution. Lastly, employer's contribution to employees on behalf of employees. Employer's contribution on behalf of what we call of employees. On behalf of employees to what we call to a members club. On behalf of employees to a members club. So employer's contribution on behalf of employees to what we call to a members club. Examples of a members club. Example of a members club. Example of a members ISPAC altogether. Contribution on behalf of employee to ISPAC, that is a members club. So not taxable together. Tax exempt if related to the work of employee. Tax exempt. Tax exempt if we say related. We call it to the work of employees. So, for example, if you're contributing for accountant on behalf of accountant to ISPAC, then that should not be taxed together. If you're contributing to what we call to an accountant on behalf of accountant to ISPAC, then that should not be taxed together. However, are we together? However, if that members club does not relate to the work of employee, then therefore you tax together. I hope that is. Where is your question? Can you post it? I have not seen it. Paul for that. Kindly forward your question. No. If any of the condition is violated, was it on passage? OCO respond with a yes if it's on passage. OCO, is it on passage? So that amount should be taxable if you violate any condition. I'm simply saying, if you violate any condition, are we together? If you violate any of the condition, then that amount should be taxed together. If you violate any of the conditions, yes, if any of the condition is violated, then you tax. Yes, the amount that is spent on passage, that amount, you tax. If any of the conditions I've said, these are three conditions. Are we together? These three conditions. So we're talking about the amount that is paid. Are we together? Passage. If you violate, are we together? If these conditions are not observed, you just tax the whole amount. You subject it. Ambuchi and Robert, are we here? I'm saying, number one, I say that the cost of passage is basically amount that is incurred in the course of employment. Are we together? To move from one place to another. So you tax the amount. If any is violated, then that should be taxed. Say passage. Say from 5,000, passage relating to employees' work. Passage is the cost of moving. So if the whole amount was the cost of moving and there's violation, anything is violated, you tax the whole amount. I'm saying if the cost of moving is 5,000, the whole cost of passage, or 3,000. Yes, if the cost of passage, the cost of moving was 5,000, and any of the condition is basically violated, you tax the whole amount together. Perfect, thank you. So then I was on employer's contribution on behalf of employees to a members club. And you're saying that we don't tax if basically that amount basically relates to the work of employees. And we are talking about payment for accountants to ISPAC. You don't tax. Then you proceed to what's called the non-cash benefit. So what is a non-cash benefit? When you say non-cash benefit, what do you basically mean by non-cash benefit? When you say non-cash benefit, what do we basically mean by non-cash benefit? So what is a non-cash benefit? When you say non-cash benefit, so they basically accrue to employee. We call it accrue to what they call to employee in what call it a non-monetary form or non-monetary. We call it non-monetary form. They basically accrue to an employee, basically in non-monetary form. Examples of non-cash benefit or non-cash benefit in kind. So we have first one. So we have it as a benefit. Number one is benefit in kind. So what is benefit in kind? When you say benefit in kind, what do you mean by benefit in kind? As the first one. As the first one, do you mean by benefit in kind? What do you basically mean by benefit in kind? So basically, when you talk about benefit in kind, this is basically, you're given a free product, which together in form of a good, in form of free transport, which together free transport. How do we tax it? The question is, how do we basically tax it? How do we tax it? How do we basically tax it? How do we basically tax it? How do we basically tax it? How do we tax it? How do we tax it? How do you go about taxation for benefit in kind? And how do you go about it? How do you tax it? How do you basically tax it for benefit in kind? In form of a free good, free transport, that is benefit in kind. How do you tax it? Benefit in kind, how to go about it? There were changes to the meals. Meals, there were changes. If you talk about meals and butcher, there were changes to the meals. Yes, to the meals, there were changes. We know that when you talk about meals, there were changes. So this should be, if it's above, what you call above that 6,000 per annum, you tax altogether. It's above that above that 6,000, you basically, hold on, yes. Hold on. Hold on, don't go to the car benefit. I'll say for the meals, there were changes altogether. So what are the changes that were affected? Meals were affected, but now I'm still on benefit in kind. So benefit in kind. Yes, just hold on, Chepchumba. Yes, it is. Hold on, Chepchumba. Yes, car is a non-cash benefit, but hold on. I'm still on the benefit in kind. Are we together? So 3,000 per month and 36,000 per annum. 3,000 per month, 3,000 per month and 36,000 per annum altogether. So we say if it's above, that is above altogether. We don't less altogether. Let's say, for example, the whole year is 400,000. The meals is 400,000. Are we going to less 36? Are we going to less 36? We're not going to less 36. Once it's more than, you simply tax the amount that is more than. You simply tax the amount that is more than. You simply tax the amount that is more than. You simply tax the amount. Then I've told you on meals, there were changes. On meals, there were basically changes. So what are the changes that were effective? That is last year around December. What are the changes that were basically effective on the meals? For the meals, Aziz, what do you mean by the difference? We're simply saying that if it's more than, you now tax. If it's less than, you don't tax. You don't. Okay. This one I give you. Check for me meals and give me meals. There were changes. If you're very keen, there were changes to those meals. Are we together? For the meals, there were changes. Sheila and the rest of the team, are we together? You check on that for the meals. Aziz, if it's more than, you don't less. You don't less. For the meals, I want you to go back and check. Ask yourself on the meals, changes to the meals. Aziz, you don't less, you just tax. Once it's more than, you tax the whole amount. Lenovo has it. Lenovo, that is what. I need you to be very keen on those tax. There's a lot of changes. When it comes to tax, there should be a lot of changes. Lenovo has it. That should be 5,000. The meal should be 5,000. There was changes to it. That should be 5,000 together. So for the meal, that is 5,000. So don't confuse Aziz. Yes. So don't confuse. We are not saying that in excess. We are saying that for this benefit in kind, once it's more than, you don't less, you just tax. Once it's more, you tax. If it's less than that, you don't tax. Mary, together. Not like the per diem. It's not like the per diem. Together. It's not as the per diem. So once it's more than, even the meals, are we together? Even the meals, once it's more than 5,000 per month or 60,000 per annum, you tax, not excess altogether. Together, Mary and the rest of class, I need a yes before I move to something else. I need us to respond with a yes. Yes, I need us to respond with a yes. You don't treat it the whole amount. You just tax the whole amount. You just tax the whole amount. I know there's a confusion there. People sometimes when you talk about these meals and meals, you say that was increased to 5K, 60,000 per annum, not at 4. That these changes. And very important, I want us to note that for this, there's always a lot of changes. Do you think the tax that we're going to teach in the next, the people who are going to see it 4 years from now, do you think the content is going to remain the same? There has to be change. The things that are going to remain the same, but the things that are going to change when it comes to tax altogether. The things that are going to change altogether. You wonder why, for example, why things like SHIFT are not being tested, because there is just a lot of changes that keeps on. SHIFT, there's a lot of changes that keeps on coming to it altogether. So for tax, you realize that the things that we're going to teach, some of the concepts, maybe in the next 3 sittings, are totally going to be different from this. That is what I'm saying. So we get to the next benefit in kind. We go to services provided by employer. We call it number 2, services. We call it provided. Services that we say are provided. We call it services provided by employer to employees. By employer to employee. Services that are basically provided by employer to employees. So number 1, let's say, for example, one, we say that payment of telephone bill or free airtime, payment of telephone bill, or what we call free airtime, we call it for private use. How do you tax this for private use? How do you basically tax that? How do we tax that? How do you tax that? So that is 30%. That is what we call 30% of telephone bill. We tax 30% of what we call of the telephone, of what we call the telephone bill stock, the airtime. That is how we tax it altogether. What about you're provided? Number 2 is now when you're provided with furniture, your provision of a furnished house. Now on provision of what we call of a furnished house. Provision of what we call a furnished house, or what we call the furniture benefit. Call it the furniture benefit. Furniture benefit. And be very keen out together. Furniture, that's not motor vehicle. Be very keen. Furniture, Chepchumba, 1%. That is 1% times number of months. Times the cost of furniture. So look up. So take notice of this. Take notice of that. Take notice of that. Yes, take notice of this. So when you're calculating this, you have to check what? We have to check what's called the month. Don't assume the whole year. Sometimes maybe somebody has gone to the house. That furniture was provided from 1st July. So 1st July to December is essentially how many months? 6 months. So you have to be very keen. If you're given an equation on tax planning, which option can you go for? You check the month. Kindly check this together. We respond with a yes. We respond with a yes. Perfect. And some people wonder why we teach this. It has to be taught because there are some people who have taken a bit of time to do these things. Are we together? If you skip this, there are some people who have taken probably a bit of time to do this. Are we together? Or maybe they did it a long time ago. So that's why we can't assume this tax planning. If you're given a question to compare two options and you don't understand these things, you'll not be able to answer that. So then we go to provision of a servant by the employer. Provision, we talk about provision of what you call of a servant, provision of what you call a servant to employee, to the employee, to the employee by the employer. By the employer. So provision of a servant, what I call provision of a servant to the employee by the employer. How do you go about the taxation of that? Provision of a servant, what I call provision of a servant, provision of a servant. Provision of a servant, provision of a servant to employee by the employer. For example, you're provided for a driver, you're provided for a watchman, you're provided for a chef or a cook. How do you go about it? How do you go about it? So the payment, the taxable amount, we understand that taxable amount will be, we say that the higher of, we call it cost to the employer, cost to the employer. And then we have what we call the market rate. So you pick the higher. But in most cases, you're not providing the market rate. Are we together? In most of the questions, you're not providing the market rate. And so therefore you just get the cost to the employer. You realize that in most questions, you are not providing the cost to the employer. So you simply get what you call you're not providing with the market rate. So you simply get the cost to the employer as the taxable amount, as the taxable amount together, as the taxable amount together. So say amount, we have, we move to the next, what we call, we have what we call now payment or provision of water and electricity. Next is payment and provision or stock provision of what we call of water and electricity. Electricity. Payments to what we call provision of water or electricity. So in this case, you're just going to compare two things. The taxable amount to say is the higher. We call it the higher of. We have cost to what we call to the employer. You compare with what you call commissioner's rate. We understand provided in what you call in the tax table, provided in the tax table. So we get the cost to the employer. You compare with the commissioner's rate. We say provided in the tax table, and you get the higher of the two. Cost to the employer, you compare with what you call the commissioner's rate provided in the tax table. Do we have a tax table? Do we have the tax table? Took on a tax tables? Yes. In every paper for taxation, this would definitely be there. So look at down there. After that all bordered table, down there after the all bordered table, after the all bordered table, after the all bordered table, so down there we have commissioner's prescribed rate. So being told electricity, communal or generator, communal or generator. So most of the questions are maybe from community, most of them are basically from community. Are we together? So from communal, you basically, if it's electricity, we understand that cost to the employer, that depends on the question. Then you have commissioner's rate. What is the commissioner's rate for communal? That is electricity. What is the commissioner's rate per annum? Per annum, what is the rate of the commissioner? 18,000. 18,000 per month. So what about agricultural? We say agricultural is subsidized. Agricultural, if it's agricultural, we have what you call the cost to what you call to the employer. To the employer, you compare with the commissioner's rate. What is the commissioner's rate for agricultural? What is the commissioner? You pick the highest. Commissioner's rate for the agricultural, 10,800. 10,800. That should be 10. We have it as 10,800. So the higher. For the water on this other side, we have the cost to what you call to the employer, the cost to the employer. Then you compare with what you call the commissioner's rate, with the commissioner's rate, water communal for water or generator, communal, water for the communal or from borehole, sorry, communal or from borehole. So that is 6,000 per annum. So this is, we compare and get. For agricultural, we have the cost to the employer. We have the cost to the employer. We get the figure. Then we have commissioner's rate. So what is the commissioner's rate for the agricultural? Commissioner's rate, that is 2,400. And I want to ask a very simple question. Kila mtu ananipata? Is everybody with me? Kengo, are you together with me? Perfect, Gilbert. Thanks, Kater. Aziz, are you together? Victoria, Lenovo, Walter, and perfect. Thank you. That is good. So then we move to provision of motor vehicle by an employer. Provision of motor vehicle. What we call provision. We call it provision. Of motor vehicle. Provision of what we call motor vehicle. Provision, call it provision of what we call a motor vehicle. Provision of what's called motor vehicle to the employees, by the employer, say for private use, So if there is what's called provision of motor vehicle, to the employee by the employer for private use. How do you go about it? So how do you go about it? So we understand that the taxable amount, taxable amount, we say, is the higher. The taxable amount is the higher. You compare two things. We say 2% times the number of months. And look at the word. This word is initial. I have not said NPV, but initial cost of what they call of MV. Initial cost of MV. 2% times the number of months times initial cost of the motor vehicle. Then I compare with what we call motor vehicle. We're comparing to the motor vehicle CC. So you compare these two and you pick the higher. So we say 2%. Perfect. People already have it. So 2% times, and the word initial, not in net book value together, but say initial. We call it initial cost of motor vehicle. What if in an illustration, maybe you're comparing two people, you're given the net book value. Net book value, let's say examiner has given you the net book value was this. And because this was accountant, the depreciation for this was, let's say 400K. If you're told 2 million, and this was the net book value and the depreciation, because these are basically accounting. What are you going to do? You're going to add back this to get the initial value. That is basically 2 point. That will give us 2.4. That basically will give us, we use the initial cost. We use what we call the initial cost together. So where do you get motor vehicle CCs? Where do you basically get motor vehicle CC? We also get motor vehicle CCs from the tax table. Are we together? Yes. Take me back. I'll take you back on agriculture. So down there, the 2.4 for agricultural, we say for agricultural cattle, we basically say that for agricultural employees, that is subsidized altogether. For the agricultural employees, it's reduced. Are we together? For agricultural employees, basically reduced altogether. So for agricultural, we say that reduced rates of benefit. That is for the agricultural employee. That is what you have for agricultural employee. Cattle, together. We respond to the yes if you're together. For the agricultural employees, we basically have what we call reduced benefit. That is the difference. Maybe explain to me. I seem not to get you. Maybe I can take you off the loudspeaker. Let me unmute you, then you communicate directly to Mwalimu. Kindly do so.
Mwalimu, when you said 2% multiplied by month, what do you mean? Because you put
the number of months.
The number of months. So
just a minute. We have two things. We have two things here. I don't know. Sheila is explaining. Just a minute. Then I get back to you, Aziz. Huh? Sheila, what are you explaining? 2,004. Yes, 2,400 for what? For what? This is electricity. Sorry, electricity. This is for what? Water. Keter, is this now clear? Keter, you respond. Keter, got it. Perfect. Aziz, back to you. You can proceed. Aziz?
So it is, yes, Mwalimu?
Yes, now you can proceed.
On the provision of motor vehicles?
Yes.
I can see it is taxable amount. The taxable amount is the higher of, then the formula is 2% multiplied by month multiplied by initial cost.
Yes.
That is to say what? To say if...
Let's say, for example, if this motor vehicle was basically provided mid of the year, let's say this motor vehicle was provided on 1st July. It means to the end of the year, how many months are you going to have? You're basically going to have 6 months. 6 months. That's what you're saying. So a lot of time, there's always an assumption. Learners basically assume a whole year. But the key thing, you have to be very sensitive to the period in which the motor vehicle was basically provided. That is what I'm trying to tell you. You need to be very sensitive to the period in which the motor vehicle was provided. Together, Aziz.
Okay, Mwalimu, now.
Yes.
If you know a year has 12 months.
Yes.
Right?
Mm.
So if the vehicle is provided midway, then should you apportion it to 6/12 or you multiply by 6 direct?
We say you multiply direct. Don't apportion. You multiply direct. How it together?
So it means if the vehicle is provided in January, you multiply by 12 months.
Yes, you multiply by 12. This is per month. 2% is per month. Look up. Okay. This 2% is per month. Per month. That's why per month.
Mwalimu, there is a provision.
Yes.
The provision where you say 24% per annum, which means if you have to take 24.
Now 12 times 2, assuming that was the whole year. However, in questions, it will not always, some questions will not be 12 months. Though most questions that are normally set is now 12 months altogether. That's why we say 24%. However, take note of this, knowing that not all questions will have the 12 months, you'll have the 12 months. Somebody says, thank you, cousin. Keter. That's okay. So now we take off the speaker. So this is, we can rest this. So this is done. So again, on issues of lookup, on issues of prescribed rate, do we have them in the tax table? Look at the tax table. I want us to look at that tax table. Somebody will wonder, what is this motor vehicle CC? What is this motor vehicle CC? Are we on the tax table? If you're there, we respond with a yes. I know why this has to be taught. Because maybe you'll be given questions, particularly on these concepts. And then you're supposed to calculate. If we don't get it, because some of us maybe have not done this recently. The people who have done it maybe last sitting, so they understand the concept. So how do you go about this? If look at the tax table on the right-hand side, prescribed benefit rates for motor vehicle. Do we have it? Can we see it? Prescribed rates for motor vehicle. Are we able to see it? You just give me as perfect as this. So for the first category, be very keen on category. The first category is for saloon cars, hatchbacks, and estates. So event up to 1,200 cc, the rate is 3,600 per month and 43,200 per annum. If you look at between 1201 to 1,500 cc, the figure should be 4,200 per month and 5,400 per annum. When you look at between 1,501 cc to 1,750 cc, the figure is 5,800 per month and 69,600 per annum. If you look at the next, that is 1,751 to 2,000 cc, the figure is 7,200. The figure is 7,200, that is per month, then 86,400 per annum. If you look at between 2001 and 1 to 3,000, the figure is 8,600 to 103. That is the whole year per month is that. So that's why, Aziz, whenever you're told this check, are we together? Don't assume the whole. If it's the whole year, we can just pick out together. If it's the whole year, for this, we simply just pick those values. But suppose this vehicle does not run for a whole year, you must be very cautious and pick. You now take the month, then you multiply, depending on kappa. CC means cubic. Yes, that is simply capacity for the CC. So there's the second category. An examiner can be very creative. Are we together? However, in most cases, examiners are not very creative. Examiner can tell you the motor vehicle was pickup, or it tells you panel van. That is unconverted. Are we together? So up to 1750 cc, that is 3600 per month, 43,200, that is per annum. But for unconverted, that is the pickup and panel vans, above 1750 cc should go for 4200 per month and 5,400 per annum. Then lastly, if it's all Land Cruiser, we simply have 7,200 per month and 86,400 per annum. Are we there? So number one, if you're given that question, be also keen on what you've been asked. Be very keen on what you've been asked. Is it the normal motor vehicle? Is it the pickups? Is it the panel vans and pickups? Is it the Land Cruisers? You have to be very keen. However, if the examiner just presents a motor vehicle, which one do you use? Do you use the first part, the second, or the third? If examiner, yes, you compare, you use the first one. You compare the figure that you're getting here with the motor vehicle CC. The figure that you're getting 2%, you compare with the motor vehicle CC and get the higher. Together, we respond with a yes if you're together. We respond with a yes if you're together. Perfect. I think we can have our break. We can have our break, then we come back. So we can have our break, then we come back. Is that okay? Or you don't need a break? We can have our break, then we come back. So we can have it. We should not include break at all. Next time, we should not be having a break. Maureen, next time we should be working without break. Yes. So then we get to the NB. Are we there? If you're there, we respond with a yes. We have Sheila points noted. It was a light note, just a light note, a light note. So point noted, we say that there's if the motor vehicle is hired, stock what they call leased from third party, what happens? Do we use the formula? So we basically say that if the motor vehicle is hired, stock leased from third party, we ignore the value and use the lease value. Look up. If the motor vehicle on the NB is basically hired, stock leased from third party, we basically ignore the formula and we use what? We use the lease value. If the motor vehicle is basically hired, stock leased from third party, we ignore what? We ignore the formula and use the lease value. Together. Together. Perfect. Lenovo, why did you say no? I've said that if the motor vehicle is hired, stock leased from third party, meaning that the motor vehicle is not basically owned by the company, we ignore the formula and we use the lease value. Lenovo to Kosawa, we respond with the yes, kama to Kosawa. So say if the car is rented from third party, if what they call the car, we say is rented from third party. If the car is basically rented from third party, now I'll say that if the motor vehicle is leased, stock hired from third party, implying that the motor vehicle is not for the company, we ignore the formula and use the lease value. We ignore not owned by the company. We ignore the formula. and use the least stock what we call hiring value. So basically ignore the formula and we use the least stock hiring value. I hope that point is at home. Then the second point, if the car is partly used for what we call for official, and partly, we say for private purpose. What is the taxable benefit? If the car is basically used partly for official and partly for private, what would be the taxable benefit? Would it be the official or the private? If the car is basically partly, is the private. The private would be what would be the taxable, would definitely be the taxable benefit. So the private would definitely be what called the private would be the taxable benefit. The private would definitely be what you call the taxable benefit altogether. For example, examiner can tell you, that official, we have it as official. The official was 40% and private was 60%. So basically on these formulas, we just come in, put what? 0.6 and 0.6 together. We'll use 0.6 and 0.6 because the private is what? The private is what is taxable. On those formulas, we'll use 0.6, 0.6. Perfect if you're together. So that is conclusively, I hope that is conclusively sorted. That is basically conclusively sorted. So then we go to what we call housing benefit. We go to what we call housing benefit. So what is a housing benefit? Housing benefit. Housing benefit. What we call the housing benefit. So housing benefit. So what is a housing benefit? When you say housing benefit, housing benefit. What is a housing benefit? What is housing benefit? Yes. Employer provide a house to employee. Employer. We say provides what we call a house. So what we call accommodation. To the what we call to the employee. Accommodation to the employee. So accommodation to the employees. So how do we go about it? So then we have what we call ordinary employees to full-time service directors. Ordinary employees to full-time service directors altogether. So we basically compare the taxable amount, taxable amount would be 15% of what we call of the total employment, 15% of the total employment, tuko pamoja, 15% of the total employment benefit Then you say market value. We compare with the market value. The market value. We compare with the market value. Rent paid in case for rent, if there's rent paid. We say in case rented. We say from the third party together. So we can have scenario now, you can have market value and 15% of the employment income. Tuko sawa team. I want us to respond. The few things that I want to emphasize here. Tunapatana. Perfect. You see, if you're dealing with the housing benefit, that will be the last item after getting the total employment income together. That will be the last item that you calculate. In scenario where you want to sort the housing benefit, that should be the last item. Are we together? That should be the last item. Are we together? Especially when it's not paid in cash or together. This should be the last item. The housing benefit will be the last, especially when it's not paid in cash. It should be the last together. It should be the last item. In case of non-cash, it should be the last. But we have scenarios where, in this scenario, we say 15% of what we call total employment. We have scenario where it's being deducted some amount towards the house. So we say we're less on contribution. We will less on contribution. Contribution, you get the higher, then you less. You get the higher of the two, then you less. If there's own contribution, we call it towards rent together. You have scenario where it's being deducted a certain amount towards rent. So you compare the total 15% of total employment, you compare with market value, or if it's rented from the third party, you get the higher, then you less on contribution towards rent. And that is what's called the nominal rent. Nominal rent. Tuko pamoja. You less what's called own contribution towards the rent. Tuko sawa. We respond with a yes. Perfect. Thank you. Perfect. So then we have scenario now for agricultural employee. Agricultural employees. So when you talk about agricultural employees, these are those that live within the plantation, within a farm or the plantation. So agricultural employees basically living in the farm or the plantation, living within the farm or what you call the plantation, living within the farm or what you call plantation, living within the farm or what you call the plantation, living within the farm or what you call plantation. So what do we use for the agricultural employees? We say 10% times total employment or gross employment, total employment income. Then you compare. We basically compare with the market value, or we compare. Then we compare with the market value if you have the market value. You pick the higher, then you can less own contribution. Own contribution, we call it towards what we call the rent. Own contribution towards the rent together. Then you can less own contribution towards the rent together. Own contribution towards the rent together. Are we together? Give me yes if you're together. So if NB, if the employee is living, agricultural employee is living outside the plantation, outside, if the house is provided outside what we call the plantation, if the house is basically provided outside the plantation, we use what? Use what we call 15% instead. instead of what you call 10%. 10%. So basically, if the house is basically provided what you call outside the plantation, use 15% instead of 10%. So if the house is provided outside the plantation, use 15%. This is in case the house is provided within the plantation. So outside the plantation, use 15% instead of 10%. Tuko sawa. Tubonyeza yes. If you're together, we give it a yes. Perfect. So then we can go to now employee share purchase options altogether. Employers share purchase option. Employees share purchase option, sorry. Employees share purchase options. What they call employees shares purchase option. What they call the employees share purchase option. Employees share purchase option. Employees shares purchase option. So in this scenario, we can have shares being given for free to an employee or given at a discount altogether. It can be given as for free. We have scenario being given for free, or given at a discount. So if this is provided for free, you just say the taxable amount will be the number of shares times what's called the market value. So if the shares are given for free, the taxable amount we're saying should just be the number of shares, and you say times the market value, number of shares times what we call the market value, number of shares times what we call the market value together, number of the shares times the market value. If the shares are given by the employer for free, how do you get the taxable benefit? The taxable benefit should just be the number of the shares times what we call times the market value together. Give me yes if you're together. So if the shares are given at a discount, so the taxable amount in this scenario will be the number of shares times we have what's called the market value minus the price given by the employer. And the price given by the employer is now at a discount. Remember, this is larger than this. So you say the number of shares, market value, which you know the price given is lower because this is the discount. So if you get that, you get when shares are given at a discount. When shares are basically given at a discount. That would give us when shares are given at a discount. Together. That is how we basically calculate that. Together, if you're together, we respond with a yes. Perfect. So then we have what we call gift to employees. How do you treat gifts to employees? How do you treat rewards to gifts to the employee? How do you treat rewards? How do you treat rewards? Let's say, for example, gifts to rewards to employee. Such would be taxable. Maybe you're rewarded for being the best employee. Such should definitely be treated as a taxable. Are we together? Are we together? Such should be, yes, such should be taxable together. Where we say if the gift is in kind, the market value is the taxable benefit altogether. Then we proceed to what's called allowable deduction. Allowable deductions. Allowable deductions. Allowable deductions. What is the difference between allowable deductions and set-offs? What is the difference between allowable deductions and the set-offs? What is the difference between allowable deductions and the set-off? So I've got into allowable deduction. What is the difference between allowable deductions and the set-off? What is the difference between allowable deductions and the set-off? Allowable deductions and the set-off. Set-offs from the gross tax, perfect. And allowable deduction, we less them from there. Yes, meant to reduce the tax payable. At the end of the day, both of them are going to reduce the tax payable. But then when you talk about allowable deduction, we less them from the taxable income. When you talk about the set-off, we less them directly from the gross tax payable together. So allowable deduction, we less them. Before we subject them to tax, we less them from the taxable income. But now for the set-off, we less them directly from the gross tax payable. If you look at this pension, we had discussed pension. Did you discuss pension? Yes, did you discuss pension? Did you discuss mortgage and the set limits and the changes that have been effected? Did we? Yes, we did discuss. Those ones we did discuss. Those ones we basically did discuss. However, we did not discuss what we call home and personal care incurred by people living with disability. Home and personal care incurred by people living with disability altogether. For example, personal expenses incurred by people living with disability. For example, drugs, the cost of drugs, cost of items relating to their disabilities like wheelchair, those are also treated as allowable deduction. Those are basically treated as allowable deductions together. Those are treated as allowable deduction together. And I want to introduce a few things on that. We just discussed. I want to introduce a few things on that. I will also talk about contribution to for example, to a member's club, if not reimbursed. If you're basically contributing to ISPAC and the employer does not reimburse you, how do you treat it? If you're contributing to a member's club and it's not reimbursed, how would you treat it? We will treat that as also allowable deduction. We respond with a yes if you're together. So if you're contributing to, for example, to ISPAC as an accountant, and that amount is basically not reimbursed, we also treat it as allowable deduction together. We also treat it as allowable deductions. We also treat it as allowable deduction. We respond with a yes if you're together. We respond with a yes if you're together. You can have contribution. Maybe an accountant has made a contribution to ISPAC, and this amount basically is not reimbursed. You can use it as allowable deduction. But again, we have what we call direct expenses. For example, you are a salesperson. You have used your money to travel in order to carry out the work of organization. And that amount, basically, you have not been reimbursed. In that case, those direct expenses also you will treat as allowable deduction if not reimbursed together. If not reimbursed. A watchman has bought his own uniform, and this amount the employer has not reimbursed, he can treat it as allowable deduction. Together, team. As allowable deductions. You can treat it as allowable deductions. Perfect, Ifyere. So in the next class, that is on, the next class is on a Friday. I will do an example. I will talk about capital structure. I will do that, talk about the capital structure, then start on the ADR. Two things that I have the ADR, this handout for ADR and digital taxes. These handouts, I'll send them in digital taxes. So these are the handouts that I want to discuss. Of course, when I finish, I will discuss these two handouts: alternative dispute resolution mechanisms and the digital taxes. That is my plan. So after that, I want to pick on these handouts. So after that, I want to discuss ADRs and I want to discuss the digital tax. So that is my plan. So when I get to the next class, that is on Friday, I will pick an example, a small example, discuss, try and see those tax planning opportunities. We finish, but then I'll give you the handout for ADR and digital taxes together so that we discuss this together. So that should be my plan for Friday. So I want to say that God bless you and God bless our class. Still a reminder, we have our blocks starting on next week. But again, we also have what we call the early bird offer. For those who pay 2,000, there's an offer. Instead of 2,500, you can have that offer. Remind your friends. I know the people with other units in this place, you can decide to take one of our units, or if you have two that you're not joining class, it's a good opportunity for you to join the blocks and do the revision. Is that right? Robert, Walter, Victoria, Lenovo, and support focus, if you can, support us. Thank you so much. We are going to touch on these two handouts, ADR and digital taxes. That's what I intend to touch on. Thank you. Kindly support us. Do not forget about us. Yes, and your friends too. You can pass that information to them. Yes. Those who are not in our tax class and they want revision, kindly tell them to come. Maybe they were in other colleges, but they need where they can revise. Please push that agenda for us. We wrap it there. God bless you, and God bless our class. Our class is ended. Good night, Abuche. Thank you, team. Thank you, Mary. Good night, Robert. Thank you. Thank you, Sharon. God bless you. Good night, Victoria. God bless you. Thank you, Aziz. God bless you.